So, I wanted to talk a little bit about the unlikely way to do well at investing and the more likely way to do well, just a little bit. The unlikely way to do well is to be a person who knows, like a venture capitalist does, that about one or two out of 10 of the companies that he invests in is going to really run. And so he's going to place a whole bunch of bets. I mean, it really kind of boils down to that. And he's going to be dealing with companies that are they're all kind of either startups or in a phase that would be considered to be a startup. And some of them are going to run. Like for Mitt Romney, Home Depot, I think was one, or Staples, whatever it was. And it ran and it runs forever and it pays dividends forever. So that's one of the ways to do things. And it's unlikely that most people can do that. It's difficult to place that much money and be able to live with yourself while, you're going through the long period of those companies' gestation, getting better and having a run. But there are, great people that can do that. And then in trading, there's the trend following type of person. This is also a less likely thing for most people because trend following also includes a surprising number of false starts where you would get in, it's a false start, and you know that because you've been stopped out. That stop out gets you out of the market, and then you go look again for where you would start your whatever basis that you're doing it by. When I say it's unlikely, I mean that just most people have trouble having a larger number of losses and with the hopes that one or a smaller number of them run. But you get the theory. It actually works pretty good if you can do that, if you can be in that. And instead of being a person that bets on 10 companies and 2 of them really run, and that makes up for all the other losses and so on, it's a big scale kind of thing, then in trading, we're looking for the market that's going to run. Then it's going to give you the really good trend, and you're going to be in it for quite some time, and you're going to book some profits, but you're going to be holding for a long period of time. But on the way to that, you're going to be in a number of positions that have to be stopped out and then restarted. And those are the companies that didn't run in a sense. And trend following may be the most successful kind of trading to many people. Certainly when you make really big gains on trades, no matter how you feel about it, you're tortured to get out and all that stuff. If you really let that trend run, and if it really does run, you have substantial, unbelievable, sometimes gains. So that's another example of the less likely, more difficult thing to do. What I've discovered is that it's better and easier to just work on being correct instead of playing statistical odds. When you play the statistical odds games, you're almost leaning away from, you're going to place your best bet, but you have to place a lot of money to be right, and it becomes a little bit like a horse race. And I know for me, I can't really deal with that. For me, I have to, and I think for many people, you just want to learn how to be correct. And if that means you wait around until it's really super obvious that you can be correct, that's what you're willing to do. That's the price that you're paying. There's a price for everything. You're given your body and your mind, and it all is going to take care of you. But once you get involved in the world and its events, no matter what you do, there is a price that you pay for being able to do that. There's some kind of price to be paid. And in this particular approach, which is the one that I'm describing as probably more likely for you to succeed at, you're actually paying the price of not taking a lot of the trades and a lot of the moves that you see in front of you, because you're waiting for it to be really obvious, really easy, and really obvious that is what's going to happen. That you have a really good trade. And I have found that is a lot better for me, and I think for many people. It's just that many people don't have the, there's a price to pay. You have to wait, you have to have patience. You have to wait for the easy and obvious moves. You have to check through all your charts to see if easy and obvious is in front of you at any point in the day. Sometimes they just throw easy and obvious to you. It rains on you. You're not fast enough to get it all. Sometimes you have to wait a little longer for easy and obvious. But the payoff is that you tend to be correct on your trades, and you tend to be satisfied that you did the right thing. The satisfaction isn't in the waiting, right? The satisfaction comes when you place the trade and it's successful and you say, okay, well, I waited my turn, I waited for this to happen, and so on. It doesn't mean that every trade is going to be correct. And then I want to address the issue of stops, because I think there's a lot of things that could be said about stops. Certainly, a mechanical system is going to require a stop at some point, right? Because the trade is either right or wrong, and at a certain point, it's wrong. And you could say that's true for particular trades of any kind, in any kind of class. But I want to kind of draw something out for you. Let's just say that you had the knowledge that the market, which had been coming down, was, you waited your turn, you figured out, was going to do this. Let's just say that each one of these blue lines represents a day. And you know that this is really likely to happen for whatever your reason is. I mean, I'm not going to address the technique. I'm just going to say, you know that that's likely going to happen. You've done your homework, you've waited your turn, and so on. And let's say that after the market starts to confirm that move up, that you end up buying a position. And let's say that, now I'm going to move over here, and let's say this is an hourly thing. Let's say you're buying on this day right here, you're buying an hourly pullback, like right here. And if you're correct, the market continues to move higher and continues to confirm the daily and starts to go up. But now let's talk about stops and what happens if you happen to be in a position where under normal conditions you would be stopped out. Well, under these conditions, I don't use an immediate actual market-placed stop. So under the conditions where I know that there's 2 more days up and I'm buying a pullback, maybe the market does this, and maybe I take a little off and then does this, but it still is well within the confines of the day. I will often buy another critical spot, if this is a critical spot, and either add to this position, which is really a no-no in most trading approaches, or I won't do it and I'll sit with an open loss because I have the indication that the market's going to move higher over the next couple of days. If either I add here, or if I don't, let's say I do the more conservative thing and I don't add, and the market does turn up from here, then when the market exceeds my previous position and starts to pull back again and then suddenly is doing this, I'm adding to my position in favor of the trend. I'm either adding on pullbacks or in the favor of the trend. The point I'm making is that it isn't always a good idea to use a stop when the market is inside of a range and still hasn't told you that your larger forecast is incorrect. So a lot of my own approaches to how to take advantage of this information has me, in many cases, not all cases, figuring out what the multi-day thing is going to be, or multi-hour thing, but let's just say that these are days. And then I'm going to be buying pullbacks and just holding them inside that multi-day set of conditions. I can either add to those positions when it further confirms, or I can add on pullbacks. Adding on pullbacks is more heart-wrenching, but adding in favor of the position is also is a lot less heart-wrenching. So there are conditions where I kind of have a double back stop, where instead of me just saying, oh, I think the market's here and it's going to go there, and no consideration for the larger picture, and I'm either right or wrong, I'm going to have to use a stop. But if I really do have the larger picture dialed down and I've done the homework and I see places to buy on shorter term, I won't use a stop. They will have to show me on the daily chart that I'm wrong, and that will cost me quite a bit more. But in those cases, if the market does show me that they're broken, it often means they're going to go a lot lower because the nature of the forecasting that I do has that. So this is where the stop and reverse comes in. So I'm looking for a layered set of conditions where my long position is really backed by a very apparent larger position that's going to go a lot further than simply making a few points on that trade. I hope that makes some sense. And because of that, I won't use a stop if the market moves against that position, but is still confirming the daily. At some point, I'm going to know I'm just plain wrong. And because of the nature of our forecast, it's hard, but I would stop and reverse. And the goal would be to get the loss down to a very small size, or even break even, or even a gain, depending on whatever the conditions are for the market to go down under these conditions. Does this all make sense? So the more knowledge that you layer into this, the more understanding of the separate conditions of the market when you're putting a trade together, the more you can be variable with how you manage the knowledge that you're incorrect. And in most cases, if you've waited your turn, you have a very much higher likelihood of being correct than you would if you're just trying to make, quote unquote, your points for the day. I hope I never hear any of you say the phrase, I'm just trying to make my points for the day, because you know that isn't my cup of tea, right? And I'm not saying that my way is the only way or is the best way. And I don't want anyone to think that I think that way, because I know too much that, there's many, many ways to do this. But for me, it's not my way. And I have found that it's much more satisfying, gratifying, and, dare I say, profitable, even though I hate to talk about money, to be the person that waits for your turn so that you can say, well, this I really understand. And I know it's true on any developmental level, because I remember doing it in 1993, 1994, when I traded for the mother of my daughter, and I didn't know a whole bunch in 1993 and 1994. But I was able to find things. I was waiting my turn because I really had no intention of trading for her, as you may have known that story. So does this make sense to you? I layer this stuff together so that I already have a larger thing that's likely going to happen. And then I can snip around a bunch of trades in direction of the larger trend here. And if they go against me, I'm much less likely to need a stop or use one, because the larger picture still is intact, even though the hourly may be against me. So that's something that you can do when you have a multi-layered approach and you're not just simply looking for a 2-point bounce or something really, small like that in a trade. So I hope that makes some sense. I want to hear from you today.